In this section, we're going to talk about venture capital again, but this time we're going to focus on the goals, we're going to focus on the stages, the players, the terms, and this concept called dilution. So it's important to think about the life cycle of a startup business and its financing cycle in the idea of stages, right? So these companies are going to be relying on venture capital funding or some type of investment funding in order to grow, to build, grow, and scale their businesses. And so they're going to basically rely on what's called stage financing. They're going to grow their businesses in various stages, and they're going to receive investments at each stage until they're able to kind of scale off without the need for any further investment because their cash flow is caught up to their growth. And so when we think about this, we're making a lot of assumptions. We're always assuming that an increased valuation at each round. Every round, the company raises more money at a higher valuation. They use this capital to grow the business. And then conversely with that, or similar to that, or what goes along with that, is that the founders will be diluted. The founders' ownership, because they are taking investment rounds, will be diluted. Their ownership will go down. But they're going to want increasingly high valuations to minimize that dilution, thinking that their valuation will increase, will minimize their dilution. However, that's not always possible or even practical. And so let's take a look at stage financing by looking at a quick chart. So we're going to think about the ideal startup business in a bunch of stages and looking at some key players. And so you think of, as time goes on to the right there, the valuation is going to go up on the left side over there. And so then you're going to see a line that goes right to the moon, right? And so you're going to see various stages, kind of at the bottom, the early stage where there's maybe a little bit of capital and IP that's contributed, as well as there's the formation stage, there's that pre-seed stage, there's that Series A stage, and along with those stages, there's the general players that aren't fixed exactly. So generally at the earliest stage, you'd have friends and family making investments, maybe an accelerator, some angel investors follow on, and then venture capital investors kind of catch on a little bit later as you get to seed and Series A. We're talking friends and family investors. We're talking right when the company is probably an idea. There might be some intellectual property or a small amount of capital. So friends and family, those are small check sizes of between, $5,000 to $100,000. It just depends on your situation. Not everyone has friends and family that are willing to do that, able to do that, or is it even wise to do that? I mean, there's a lot of security laws issues that arise when you take investments from individuals that are not accredited investors, that are friends and family. I mean, the ideal exception would be that they have access to the information to make a decent investment decision, but that might not be true. You might not want your Aunt Sue looking through all the company's books and records. And do you even want to deal with that dynamic when Thanksgiving comes around? Also, accelerators. Accelerators are a big part of the startup community. They've been around since, they're relatively recent, but they've been around since 2005 with Y Combinator that Paul Graham came up with and founded. They've been increasingly prominent with groups like Techstars, 500 Startups. There are also industry-specific type accelerators and incubators and things like that. They're often broken up into different cohorts with maybe a specific focus on an industry or a region or some mix. They're really helpful, right? They offer a lot of benefits such as mentorship, helping businesses build their business plan, their pitch deck, their product market fit. All of these things are very, very helpful intangible benefits, and they might even include some financial benefits as well. But really, you're in it for the network and the intangible benefits that are involved. Next up, we have angels. So angel investors are usually rich individuals, connected to the network in some way that invest in startups in, $10,000 to $1 million size rounds. Obviously, they can go up and they can go down, but that's kind of what we're talking about there. After that, you kind of see institutional investors such as venture capitalists kind of come along and invest anywhere between, $2 million to $25 to hundreds of millions of dollars into companies based on the stage. Usually when venture capitalists come in at a later stage, they're not investing in the idea. They're investing in a business that already has a customer base, that's already generating revenue, and they're going to use that money to increase their market position and increase some of their services that they're offering and furthering their product and growing their market. But it's important to know that not all VCs are early stage VCs, middle stage VCs, or late stage VCs. They come in different flavors with different type of investment approaches and theses. Some VCs are, industry specific. They might be regional, and they all have their own kind of unique way of doing things. So one thing that we talked about from the very beginning when we looked at that chart was the idea that of a valuation, that the company's valuation would increase as time goes on, and they're going to be increasing the capital raised at an increased valuation each time. But what is a valuation? When we're talking about a valuation, we're talking about two different flavors of valuation. We're talking about a pre-money valuation, and talking about a post-money valuation. A pre-money valuation is the valuation of a company before it receives an investment. For instance, WeWash's value before it receives $2 million. Perhaps it is valued at $8 million and then it receives $2 million investment. The pre-money valuation would be $8 million. Post-money valuation is the value after it receives an investment. Let's say WeWash value after it receives that $2 million. So pre-money of $8 million plus the $2 million investment equals a post-money valuation of $10 million. So let's look at an example of dilution and kind of how this works within this example. So Adam and Betty each own 1 million shares of WeWash, which is 100% of the outstanding stock. Tag Ventures invests $2 million at an $8 million pre-money valuation. What does this mean? Well, we've learned a few different things here. Tag put a value on WeWash's. Tag put a value on WeWash, right? We can realize that by giving $2 million at an $8 million pre-money valuation, that post-money valuation was $10 million. $2 million plus $8 million equals $10 million. That investment was in the amount of $2 million out of a $10 million post-money. So they're expecting, after they make the investment, to own 20% of the business because $2 million is 20% of $10 million. So what happens? Adam and Betty were 50-50 owners before, but now they've been diluted because Tag's going to own 20% of the business. So their ownership percentage is going to drop down to 40% each. As part of this, Tag will get special rights. Tag's made a price round investment. They're likely going to get preferred stock, so they're going to receive some type of other type of benefits that we'll learn about in some other sections. But it's not always practical. It's important to note that it's not always practical to do a price round. Usually you see that a little bit later on. You don't see that as much. Well, you don't see that with accelerators or friends and family rounds. Sometimes angels or sometimes early stage VCs might not even do a priced round. But let's look at some of the terms of the priced round here. So when we're talking about our priced round, we're talking about the valuation, which is exactly what we just went over, the pre-money plus post-money valuation. And when we're talking about a valuation, we're usually talking about a valuation that comes with preferred stock, which is something that we'll talk about in some other sections here. We're talking about the types of rights that preferred stock has over common stock. And then we're also talking about other economic rights outside of valuation, such as a liquidation preference, anti-dilution rights. And we're also talking about control rights, board seats, and other protective provisions. So let's take a look at where kind of this looks like on the chart. So, up top there, when you're looking at maybe a pre-seed round, a seed round, or a Series A round is when you might see a priced round. Generally speaking, it's usually at the seed or Series A. Definitely at the Series A, you'd have some type of priced round. But it's important to note that not every round is a priced round. Instead, early stage investors such as friends and family, accelerators, and angels make investments without putting a value on the company. Why? Because at this point in time, it's too early to give a reasonable valuation. There's not enough information to know what the value of the company is. But these investors still want to invest. Often, it might just be tied to the belief in the founders that they can they want to make an investment in that founder or that team of founders, and it's not so much based on the product or service because that really hasn't been fully developed yet. So what they'll do is they can invest in what are known as convertibles. This is the idea of money now in valuation in the future. So convertibles are most notably known by convertible notes or safe agreements. Basically, the idea is that there's a loan that converts into equity upon the happening of certain events. So once the company does raise a price round, that loan will convert into preferred stock. That convertible note will convert into preferred stock. If there's a sale of the company, then that convertible note will convert into the better deal for the investor of the common stock or their money back. But it's going to be at a discount price. That discount price is going to be the price that's the better deal for the investor between the discount rate and the valuation cap. So this is purely an overview of convertible instruments. We're going to spend the whole next section discussing convertible instruments and the mechanics of convertible instruments, how they impact the cap table, how they impact investment rounds down the road, and some of the key terms to know and to build to negotiate. So I hope that was helpful in kind of understanding the general dynamics between investors, the various stages, the players, in a brief overview of some of the terms. Until next time, venture awaits.